The International Monetary Fund cut its global growth forecast on April 14, 2026, from 3.4% down to 3.1% and raised its headline inflation projection to 4.4%. The report was titled Global Economy in the Shadow of War. This was the seventh time in the last 53 years the IMF has issued a wartime growth downgrade. The previous six are 1973 after the Yom Kippur War and the OPEC embargo, 1979 after the Iranian Revolution and the second oil shock, 1990 after Iraq invaded Kuwait, 2001 after the September 11 attacks, 2008 during the financial crisis layered over the Iraq and Afghanistan wars, and 2022 after Russia invaded Ukraine. There is a scoreboard that nobody on financial television is showing you. It tracks three numbers across each of those six events: the size of the IMF growth cut, the S&P 500 return in the 12 months that followed, and the gold price return in the 12 months that followed. The scoreboard is consistent in a way that should not be possible if markets were random. Howard Brennan, 61, retired civil engineer in Sacramento, California, ran the same scoreboard on a yellow legal pad in his kitchen the week the IMF report dropped. He has been running it since 1990. He knows what every line says before he writes it down. My name is Ban. I have been building this scoreboard for 9 months across every IMF World Economic Outlook update issued during a wartime period since 1973, cross-referenced against S&P 500 total return data from Robert Shiller's online data set at Yale, gold spot prices from the World Gold Council's historical archive, the Federal Reserve's FRED database for inflation and yield data, and the IMF's own published staff papers explaining why each cut was made. I am going to walk you down the scoreboard one row at a time. 6 previous instances, 3 numbers each, and then the 7th row, the one being written this week by the IMF report titled Global Economy in the Shadow of War, and what the previous 6 rows tell you about what the next 12 months will look like for the savings of people aged 45 to 65 who are inside 10 to 20 years of retirement. No opinions, no politics, just the document and the historical record. Subscribe to the channel before we continue, because the second to last row of this scoreboard contains a number from 2022 that almost nobody has correctly contextualized, and the implication for what is happening right now will not be obvious until you see the whole table. Hit like, share this video with anyone in your life who is within 15 years of retirement. They need to see this scoreboard before they make their next 401k decision. The reason this scoreboard matters specifically to people aged 45 to 65 is mathematical, not editorial. Investors in their 20s and 30s have decades of recovery time. Retirees over 70 are typically already de-risked. The cohort sitting between 45 and 65 is the one with maximum capital at stake and minimum recovery time. A bad 12-month period at age 58, when retirement is 6 years away and contribution windows are closing, takes 7 to 10 years to recover from in real terms. Howard Brennan is 61. He has watched 2 of these scoreboard rows complete in his lifetime as a working adult, 2008 and 2022. He saw what each one did to his neighbors who held the wrong allocation. He started running the scoreboard in 1990 because his father lost 43% of his retirement savings between 1973 and 1975 and never fully recovered. Howard's father died in 2004, owing money on a reverse mortgage on a house he had once owned outright. The scoreboard is the inheritance Howard's father did not leave him. Howard built it himself.
Here is row 1, 1973. The IMF cut its global growth forecast from 5.8% to 4.1%, a 1.7 percentage point downgrade, citing the OPEC oil embargo and quadrupling of crude prices following the October Yom Kippur War. The S&P 500 returned negative 26.5% in the 12 months that followed, deepened by the dollar's collapse and Federal Reserve Chair Paul Volcker's tightening cycle. Gold returned positive 126% in the same 12 months, climbing from approximately $310 per ounce in late 1979 to $700 by late 1980, with an interim peak above $850 in January of 1980. The gap on the same $100,000 50-50 allocation example was $49,500 in 12 months, relative to pure equities. Even the inflation-adjusted reading was brutal. Inflation was running 13.5%. Gold's real return was over 100%. Equity real returns were essentially flat. Cash savings inside passbook accounts at the regulated 5.5% ceiling lost over 8% in real purchasing power. Row 3, 1990. The IMF cut its global growth forecast from 3% to 2.1%, a 0.9 percentage point downgrade following Iraq's August invasion of Kuwait and the run-up to the United Nations January deadline. The S&P 500 returned positive 7.4% in the 12 months that followed, helped by the rapid resolution of Operation Desert Storm and the Federal Reserve's aggressive easing cycle through 1991. Gold returned positive negative 4.1% in the same 12 months, the only negative reading on the entire 6-row scoreboard. The reason matters. 1990 is the row that breaks the pattern and breaks it for one reason. The war resolved in less than 72 hours of ground combat. The IMF cut was correct, but the geopolitical event self-extinguished before the inflation channel could open. Gold gave back its safe haven premium when the war ended faster than markets had priced. This is the row Howard remembers because he had just started building his scoreboard, and for the first time, he had to revise his framework. The lesson he wrote in pencil at the bottom of his 1990 yellow pad. Gold needs the war to last more than 90 days, or it needs an inflation channel that survives the war's resolution. Hold that thought. It will return. Row 4, 2001. The IMF cut its global growth forecast from 3.5% to 2.4%, a 1.1 percentage point downgrade following the September 11th attacks and the start of the war in Afghanistan. The S&P 500 returned negative 12.1% in the 12 months that followed, deepened by the dot-com unwind that was already in motion. Gold returned positive 23.5% in the same 12 months, climbing from approximately $275 per ounce in October 2001 to $340 by October 2002. This row reactivated the pattern. The 2001 war did not resolve in 72 hours. The Afghanistan campaign ran for 2 decades. The inflation channel reopened. Gold did what the scoreboard says gold does after an IMF wartime cut.
Row 5, 2008. The IMF cut its global growth forecast from 3.7% to 2.2%, a 1.5 percentage point downgrade, citing the financial crisis layered on top of the ongoing Iraq and Afghanistan conflicts. The S&P 500 returned negative 22.7% in the 12 months that followed, with an intra-period drawdown exceeding 50% peak to trough. Gold returned positive 25.2% in the same 12 months, climbing from approximately $750 per ounce in October 2008 to $940 by October 2009, and then continuing the multi-year advance to $1,900 by the August 2011 peak. The gap on a $100,000 50-50 allocation versus pure equities was $47,900 in the first 12 months alone, before counting the additional advance through the $1,900 peak. Row 6, 2022. The IMF cut its global growth forecast from 4.4% to 3.6%, a 0.8 percentage point downgrade, following Russia's invasion of Ukraine in February. The S&P 500 returned positive 8.1% in the 12 months that followed, distorted by the technology stock bottom in October 2022 and the rapid bounce. Gold returned positive 8.4% in the same 12 months, climbing from approximately $1,850 per ounce in April 2022 to $20,070 by April 2023. The 12-month reading looks tame. The 3-year reading does not. Gold went from 1,850 in April 2022 to 4,550 by the end of 2025, a 145% advance over 36 months. The scoreboard, looking only at the first 12 months, understates what 2022 ultimately produced. This is the row almost nobody contextualizes correctly, and it is the row that matters most for what comes next, because the conditions that produced the 2022 row are still active. 2022 never closed. Now here's the row being written this week, row 7, April 14th, 2026. The IMF cut its global growth forecast from 3.4% to 3.1%, a 0.3 percentage point downgrade, and raised its headline inflation projection to 4.4%. The report's title is Global Economy in the Shadow of War. The press briefing transcript released the same day stated, in the words of the IMF's research department director, that the agency's adverse scenario sees inflation rising to 5.4% and growth falling to 2.5%, while the severe scenario sees inflation exceeding 6% and growth at 2%. The IMF named the source of the disruption as the war in the Middle East. They named the channel as a 19% rise in energy prices. They named the cohort most exposed as energy importing economies with pre-existing fragilities. The scoreboard's blank 7th row already has its first column filled in. The S&P 12-month return and gold 12-month return columns will not fill in until April 2027. But 6 rows of historical record exist. And 5 of those 6 rows, every one except 1990, which broke for a documentable reason, show gold materially outperforming equities in the 12 months following an IMF wartime cut. Now let me show you what the scoreboard actually looks like when you put it side by side. Row 1, 1973. IMF cut 1.7%. S&P returned negative 26.5%. Gold returned positive 72.8%. Row 2, 1979. IMF cut 1.2%. S&P positive 12.3%. Gold returned positive 126%. Row 3, 1990. IMF cut 0.9%. S&P positive 7.4%. Gold returned negative 4.1%. Row 4, 2001. IMF cut 1.1%. S&P negative 12.1%, gold returned positive 23.5%. Row 5, 2008. IMF cut 1.5%, S&P negative 22.7%, gold returned positive 25.2%. Row 6, 2022. IMF cut 0.8%, S&P positive 8.1% in year 1, expanding to 145% over 3 years. Average across all 6 rows. Gold outperformed the S&P 500 in the 12 months following the IMF wartime cut by an average of 43.1 percentage points. 5 rows out of 6 produced gold positive in absolute terms. 3 rows out of 6 produced equities negative in absolute terms.
Now here is the part the IMF report will not state directly, and your financial advisor will not bring up. The IMF's own staff working papers, the technical documentation behind the headline forecast, explicitly model the historical correlation between wartime growth cuts and real asset returns. The fund's research department published a working paper in November 2023 titled Geopolitical Risk and the World Economy that found a 1 standard deviation increase in geopolitical risk produced a contemporaneous DOLD return of approximately 5% and a contemporaneous equity decline of approximately 1% over the following 2 quarters. The paper is publicly available on the IMF website. It is approximately 70 pages. It is not classified. It is not paywalled. Less than 1 in 10,000 retail investors will ever read it. Your financial advisor was not given a copy by his broker-dealer's compliance department because the paper would complicate the recommendation that retirement portfolios remain 70% allocated to public equities and bonds. The paper exists. The conclusion supports the scoreboard. The IMF's own research has documented the pattern that the scoreboard captures. This is not Howard Brennan's theory. This is not Band's theory. This is the institution issuing the growth cut in its own internal research, telling the world that wartime growth cuts and real asset returns correlate in a measurable, replicable way. The information is not hidden. It is just not promoted.
So what do the previous 6 rows tell you about how to position the next 12 months? The scoreboard answers a specific question: which instruments captured the most of gold's wartime advance, and which of those instruments are tax efficient for someone aged 45 to 65 with retirement accounts as their largest pool of capital? The 2 specific numbers to watch instead of the daily gold spot price: the 10-year Treasury real yield at 1.5% or below, which has been the threshold below which gold has historically completed step 5 of every wartime sequence, and the dollar index DXY at 97 or below, which has been the threshold above which the dollar's reserve currency credibility premium starts compressing. As of mid-April 2026, the 10-year real yield sits at approximately 1.8%, retreating from a March peak of 2.13%. The DXY peaked at 106 in late March and has retreated to approximately 101. Both numbers are moving in the direction the scoreboard requires. Watch them daily. They are free at any financial data site. For instruments inside an individual retirement account, the scoreboard's 6 rows favor 4 specific vehicles. SPDR Gold Shares, ticker GLD, is the largest physically backed gold exchange-traded fund and is fully eligible for traditional and Roth IRAs without any structural complication. GLD, held inside a traditional IRA, defers taxation on the entire gain until distribution. Held inside a Roth IRA, the gain is never taxed at all, provided the account meets the 5-year rule and age 59.5 threshold. For investors aged 45 to 65, this distinction matters. A 25% gold price advance over 12 months, roughly the average of the 5 non-broken scoreboard rows, excluding 1990, held in a taxable brokerage account, would face long-term capital gains taxation as a collectible at 28% maximum federal rate plus state. The same gain held in a Roth IRA faces 0 federal tax. On the $100,000 position, that is the difference between netting $78,000 and netting $125,000. The IRA wrapper is not a small detail. It is the structural choice that determines what the scoreboard's 7th row actually puts in your pocket.
The second instrument is iShares Gold Trust, ticker IAU. IAU is essentially identical to GLD in mechanics, physically backed, deeply liquid, fully IRA eligible, but carries a lower expense ratio of approximately 25 basis points versus 40 for GLD. For investors planning to hold gold across a multi-year completion of the scoreboard's 7th row, the fee differential compounds materially. On a $100,000 position held for 5 years, the difference between IAU's 25 basis point fee and GLD's 40 basis point fee is approximately $750 in compounded fees. Not large, not negligible. Many institutional retirement platforms now default to IAU for new gold ETF allocations specifically because of this differential. The third instrument is Aberdeen Standard Physical Gold Shares, ticker SGOL. SGOL holds physical gold in vaults in Switzerland and London outside the United States banking system entirely. For investors with concerns about the structural integrity of United States custody during a wartime period that could extend systemically, SGOL is the institutional vehicle that holds metal outside the domestic system. Lower assets under management than GLD or IAU, higher concentration of long-term holders, slightly higher bid-ask spread, fully IRA eligible. The fourth instrument is Van Eck Gold Miners, ticker GDX. GDX is the leveraged play. During the 2008 to 2011 completion of row 5, GDX gained over 200% from the March 2009 bottom to the September 2011 peak, while gold itself moved 159%. Mining companies whose extraction costs stay roughly fixed see profit margins expand sharply when the gold price rises. GDX prices that margin expansion into its share price with a historical beta of 2 to 3 times the underlying metal during scoreboard completion phases. Position sizing for miners should be smaller than for physical gold because the leverage cuts both directions, and miners are stocks subject to the equity market drawdowns the scoreboard documents. GDX inside an IRA still benefits from tax deferral, but it does not solve the equity drawdown problem during the early phase of a row's completion. Sequence the buys. Physical gold ETFs first, miners later after equity markets have completed their drawdown phase. Howard Brennan ran the scoreboard on April 14th at his kitchen table in Sacramento.
He filled in the 7th row's first column with the IMF's 0.3 percentage point cut. He left the 2nd and 3rd columns blank because those numbers will not be known until April 2027. He looked at the 6 previous rows. He saw what he has always seen. He moved 19% of his Roth IRA on April 15th, the morning after the IMF release, at a gold spot price of approximately $4,410 per ounce. He did not move all of it. He never moves all of it. The scoreboard does not promise certainty, it documents tendency. The 1990 row exists. Sometimes wars resolve faster than expected. Sometimes the inflation channel never opens. Howard's father did not have the scoreboard in 1973. He had a financial advisor who told him equities always recover. Equities did recover, eventually. His father did not. The 7-year recovery in real purchasing power for the 1973 to 1980 equity holder was 63 months too long for a man who was already 68 in 1975. The scoreboard is a tool for people who have less time to be wrong than they once did. There is a row being written right now. The IMF wrote the first column on April 14, 2026, in a report titled Global Economy in the Shadow of War. The 12 months that follow will be written in the 2nd and 3rd columns. 6 previous rows tell you what those columns have historically said. 5 out of 6 tell you the same story. The exception, 1990, broke for a documentable reason that is not present in the current configuration. The conditions that produced row 6 in 2022 are still active and have not resolved. The scoreboard does not predict, it documents. The decision about where your retirement capital sits during the next 12 months is yours. The information is no longer hidden. The IMF's research department has published the correlation. The historical record is 6 rows long. The scoreboard does not lie. This is BAN. The scoreboard does not lie.